right, welcome guys to another episode of Property and Lending, our 7th episode. We've got, as always, Fadi and Mark. How are you, boys?
Good, how are you?
Good. Mark, is your audio working?
Yeah, can you hear me?
Oh yeah, we can hear. Sorry, it didn't come out when you spoke before.
No, just good.
Our accountant flaked on us, so we've changed our topic for the week. So we'll get a new accountant hopefully soon. But today I thought you guys we'll talk about employment, different types of employment, how it affects lending, and then very briefly I'll talk about how it affects property. But this is mainly a lending discussion. But I think it's very important. So I'm just going to ask you guys questions. You guys can be informative today. What's the different type of lending? How does employment affect lending? How does different types of employment change the way you can get finance?
There's so many types of employment, like when it comes to looking at a mortgage. So we start off, like, it's pretty much down to two: PAYG, which is when you're working for someone, and self-employed, when you're obviously working for yourself. And it just depends, like for the PAYG, like Mark will go into it more in regards to, like, we've got casuals, we've got contractors. Within the contractors, we've got independent contractors, like casual teachers. Like there's a few jobs where casuals are looked at differently. Like if you're working the 40-hour weeks and you're a casual, I think the income, Mark, from memory, is shared out 48 weeks. So it takes into account, it's about 4 weeks annual leave in there. So they don't take that into account because you're casual. When it comes to teachers, because teachers obviously get a lot more time off, it's shared at 40 weeks. But I guess we'll start with the PAYG. I guess Mark will take us through that and have a bit more of a discussion. And I know with yourself, in regards to like the importance of having a pre-approval for your customers, and when you're going to negotiate, I guess with the real estate's, how a shorter turnaround period as well is an advantage, and that's why it's so important we get all this right before we do so.
For sure. So you said PAYG. We'll start with that.
Yeah.
You want to go through it, explain what that is, what's going on with that, with the
Mark, which one do you want to start with?
I don't know, normal PAYG. So you can do full-time or part-time. If you work, you would get a contract, and you'd have contractor, and you would have your hours that you work, full-time hours, typically 38 paid hours. You have a contract that specifies the hourly rate of pay as well. And these are the easiest in terms of calculating the pay that we put on the calculator, and it's the most and because it's the easiest and you can't really stuff it up. There's no usually the amount that we put through sort of gets approved. There's not really much else they look at. There's no commission, there's no bonus, there's none of that stuff, and there's no add backs with your self-employed. So there's not much that they can change. So this is your stock standard employees. Doesn't matter what industry it is. Whatever the base salary is, we can use at 100%. We put it on the calculator. Even if you're an employee, typically if you're in a sales position, you will get a commission. You might get a bonus. If you're in like the medical field, you work overtime. So all of those, anything that's not part of your base salary doesn't usually get counted at 100% unless if you're working overtime and you're part of what they call emergency services. Most banks have a policy where they will count your overtime at 100%, because they know if you're a doctor, if you're a nurse, if you're whatever it is, working in a hospital, firefighters as well, police officers, ambulance, whatever it is, paramedics, they know that overtime is a normal part of your income. So they will count it at 100% because it's going to be consistent. Every other industry that's outside of that, they'll shed it usually at 8%, 80%. Keep in mind, with all these lenders are very different. With the bonus as well, bonus is a little bit different as well. They need to see consistency in order for them to feel comfortable to count it, in order for the bank to count it. So if you have your bonus that you can show over the last two, for example, tax returns, or in your year-to-date figure with this payslip that will show most of this year as well, for example, as long as there's consistency with your bonus, most lenders will count it again at 80%. Some lenders might do less. Every bank has their own credit policies. So that's PAYG. I think I mentioned commission as well. They do it at 80% usually as well. So that's your PAYG. The only other thing there is contractors. So If you're a dependent contractor, which means that your payslip has your tax coming out, has your super coming out, but because you're a contractor, you don't get the leave entitlements like everyone else. So sick leave and annual leave, that's fine. We can counter at 100% as well. There are requirements with how long you need to be in that contract. They'll ask to see the contract itself as well. You can't be in the contract for like less than 6 months most of the time, unless you've had multiple contracts, like unless you've been doing this for years, and your current contract you've been in at 3 months. We have cases like that we get over the line as well with certain lenders. The other side of that, you might be a contractor. So for example, this is common with independent contractors. Would be common with what industry, Fadi? What do you normally see it with?
You see a lot of the IT, cyber security as well. So you find a lot of them in that sort of sector where they're known as more independent. Well, they can get a dependent role in those sort of roles, but independent basically means you're a sole trader. So mainly they looked at as self-employed as well. And I think it's important to highlight as well in regards to those sort of employments, like Mark mentioned a few in there, like with commission, like a lot of the salesmen, like where they have commission, there has to be, we have to show them some sort of consistency. With most lenders, Mark, I think from memory, they want to see at least 2 years in some sort of commission role. They want to see you in the same role that you're currently in at the moment for a minimum of 12 months. And the way they calculate the commission, for example, like once the financial year end starts again, the financial year starts again, that would wait for any people in a sales commission. They would wait to see a year-to-date figure to take into account a higher commission for the following year if you believe you're going to be making more. We need at least 3 months. So from July to September, we want to see some sort of income there. Or they work off the averages of the last 2 years. How much have you earned in commission over the last 2 years? And they try to average around that. But in most scenarios, if we're doing the home loan process after the September period, and there is a higher amount on their year-to-date figure, we try to push that with certain lenders. Of course, every lender has their sort of policy. With the bonuses, like Mark mentioned, I think most lenders are like 2 years consistent. They want to see the bonus payments like in these coming days or in the days that we're in at the moment, the present times. They want to see 2 years, commissions consistent if we are to use, because commissions are usually paid once a year in the March period in most sectors. So they want to make sure we can show 2 in the previous years and usually with the same employer.
And that 3 years year to date, that also applies for if you're doing overtime work as well. So like in a hospital, like a doctor, for example, they usually would want to see 3 months year to date figure to be able to reliably calculate that overtime. So anyone that's applying in the first quarter of next financial year, they're going to go off your tax return to calculate that.
Yep. And it's important to highlight that with teachers because we're seeing a lot of casual teaching at the moment that are coming through. So it's very important. A lot of lenders look at it differently. Year-to-date figures, they look after the last 2 years tax returns. Like there's a few lenders out there that actually look at 2 years tax returns and they go off the lower one for the income, even though your year-to-date figure shows a whole lot more on there. Just to be conservative in these days, you find some lenders going off the lower one. But of course, we've got lenders out there that will go off not so much future earnings, but going off what your year-to-date figure shows so far.
Yeah. Okay. So something you just mentioned regarding shedding, just to explain if anyone doesn't understand, when you're saying that they're shedding by to 80% or whatnot, essentially they're only using 80% of that, whatever that income was from that part. Okay. So you guys have covered quite a bit there that I had on my list that I wanted to ask about. So that's pretty good. I might just throw some random like scenarios and then you can explain how it would work. So I've just started a new job and I've got a probation period. Does that probation period affect my lending at all?
What kind of job is that? You full-time employed? So have you
a full-time employee, but there's a 3-month or 6-month probation period. Does that affect my income?
You'll find with most lenders that shouldn't be a problem with the probation. Especially if you've been in the same industry in the last couple of years as well. You've stayed in the same industry. It's usually not really a problem you run into. There are certain lenders out there that would rather you finish that probation period before giving you out a loan. But you find, especially with the big fours and most lenders, that they will look at that as long as you've been in the same industry in the last couple of years, a minimum of 2 years, yeah.
Okay. But it can also complicate things like if there's a lender's mortgage insurance involved in the deal, sometimes the bank won't have an issue, but the insurer will. So if there's LMI involved and you're on probation, Even if you're with the right lender, the insurer might not be happy with it and stop it. But if you're with the right lender who accepts probation and there's no LMI involved, then there's no dramas.
Yep.
Okay, cool.
And you'll find in those sort of scenarios, man, that's a very good point, Mark. You'll find in some scenarios, man, where the lending is up to 95%, including LMI. So they're scrutinizing that deal because you're already at a high risk borrowing 95% worth of what the property is worth. So the lenders will be looking at that deal closely. You're still allowed exemptions, of course, but like Mark said, that's a big one. When it comes down to that and you're on probation or you've just started employment, where we're looking to use the commission as much as possible, are we relying too much on the commissions or the overtime? You find the insurer mainly, the banks will be fine with it, but you'll find the LMI, which is a third-party insurer, kind of scrutinizing that sort of deal. That, can collapse a deal whether the bank says yes or no.
Okay. And if I've changed industries, does that affect, is it, you mentioned if it's the same industry, if I've changed jobs and I've gone into a different industry, is that affecting, it's just a standard PAYG. I was working as a full-time teacher and I've moved and I've become a full-time accountant.
Yep. Is
that going to affect?
After Mark made that point, if it's an 80% deal, I don't see it really affecting even if you are on probation. The moment we start touching that LMI territory, if you're on probation, you've changed industries, we'd ask for a little bit more evidence. The banks will be asking for, let's get a letter from the employer. Do they see, saying that after the probation period, they are going to be offering you a full-time employment, or they are in a position to be offering you in a full-time employment? Just more further documentation. But again, like Mark said, it comes down to the LMI territory. But if you're changing industries and you've gone into a full-time role, no problem at all. If there's no probation involved, no problem at all.
Okay, so like most scenarios, the more you're borrowing, the riskier it is for the bank, the harder it's going to get once there's different factors. Good job, Mark. That's why we keep you around. Yeah. How about this scenario, which I know we've actually dealt with, me and Mark, a couple of times recently. I've got my pre-approval, and the client's got a pre-approval. They've come to KM. We're trying to buy our own property. Hey, by the way, I've just resigned and I'm changing jobs. This is a good one. Is this going to change or affect my current pre-approval moving forward?
Yeah.
So I think a lot of people don't. A lot of people, when we talk to them, I get the sense that they think that once they get a pre-approval, all assessments by the bank have been done. It won't be done again. So anything after you get a pre-approval, a lot of people believe that nothing happens after that. As soon as you sign a contract, and we have that fully executed contract of sale signed by both parties, and we submit it, it's now not a pre-approval. We're submitting it as a purchase, and another assessment is done. Even if it's a day after you get your pre-approval, they still look at everything again, even if it's the day after. So if there's been a change in employment, especially if you're going from PAYG to self-employed, that would be the most complex case. Because self-employed,
that's not complex. That's like a nightmare case.
Yeah.
Like,
that was that.
So yeah. So we usually tell people is, if with the pay slips that you currently have, typically as long as they're not older than 6 weeks old, we can use them. As soon as we have the unconditional approval from the bank, that's them saying, we've done all our assessments, we're happy with what we've seen, this is how much we're going to give you at this loan product for this purchase of this property address at this interest rate. So
of course, in that scenario, we're still on the impression, or we're still in the interview with the clients, they haven't told us of any changes, because one of the main questions that we ask part of the responsible lending is, do you see any changes happening in the next 12 months? That's one of the main questions on there. So like Mark said, the importance of it's pretty much being upfront with us, because the importance of that pre-approval, and I say this to customers all the time, the pre-approval is there as a safety net. Of this pre-approval for the next 90 days that, the banks allowed you to borrow this money off the information that we've given them. Now, like Mark said, that's not the end of it, because some of the conditional approvals that we get, that they've looked over the information, everything that we've provided them so far looks correct, and we're able to lend on this, and then it gives us a few conditions to look at the financials again. As long as the financial position hasn't been changed as well, we get a confirmation from the customers, updated pay slips, whatever it may be. But if the customers were to change later on, or they haven't let us know, but it really comes down to the more of the responsible lending. Like that's one of the main questions that we do definitely ask. Yeah.
And the other thing is, whenever we receive communication or correspondence from the lenders, there's always a disclaimer at the bottom of the email saying at any time throughout the application process, we may ask you for more details. And if they were to ask for any new details, like an updated payslip, but you left work and you can't provide that, anything like that can sort of stop the process. So if you are changing jobs, it's definitely not wise to do so before settlement day until it's all done and dusted. But even if you are changing, obviously, like Fadi was saying, it's important to bring that up with the broker just to make sure it's not going to change things and that you won't end up with any financial loss with that deposit you put up. We want to make sure that it's going towards your purchase and you end up getting the keys on settlement day.
Yeah.
Yeah, cool. Just before we move on to the self-employed stuff, so you mentioned casual teachers obviously looked at differently to, I guess, other casual industries. In terms of commissions and bonuses, is that a standard 80% rule across the board that they're going to look at? You know, if I'm working in sales, whether it's in real estate or another industry, I'm getting X amount of base, 50,000 base, and then it's all commission after that. Is that looked at differently to a position where it's all commission or partially commission, like a small amount commission? Is it different, or is it just a blanket give or take 80% rule?
When COVID hit, we saw like a lot of industries, like, you know, car salesmen, financiers, stuff like that. Their income was actually set at 50% that commission because really there was no work going at the time. You know, obviously lockdown was happening. In most scenarios now, Mark is right, there's 80% shedding of that commission. So for example, you earn $100,000 in base, you earn about 25K in commission. We're taking 80% of that 25K, adding to your 100. It just really depends on the industry they're in, but overall in most sectors, we're looking at 80% shedding for that income. But the most important thing about this is evidence. If you've just started sales job and you're earning a big commission, we need to see the lender needs to see some sort of evidence, and it's really part of the responsible lending. They've just started in the industry. We want to see that they've earned this over 2 years, so we know moving forward, these guys want to stay in this industry. They are going to continuously earn this commission. So that's why there's that time period. Some lenders are a year, most lenders are 2 years. They want to see evidence of overtime or commission or bonuses. And you'll find those lenders out there that will go off 6 months as well. Of course, those sort of lenders, different policies come through. Rates are different as well.
Yeah. So it's about some sort of consistency just to prove to the bank that it's not a one-off big hit, and you don't get any commission for the next 2 years, pretty much.
Well, absolutely. And the way I explain it to most people in sales, think about it, and you guys already know this. In most sales jobs, the base income is usually lower. Like in a lot of the car sales job, their base income is much lower to what they really make. Most of their income is in commission. And you'll find those little tiny lenders here and there, they would say, you know what, we can't use all of it, all of the commission. We'll actually cap it at less than 80%, because if it's a certain amount over your base rate, then they won't use all of it because it's a bit of a high risk. But you'll find that most lenders, if you show the 2 years consistency and the overtime and commission, they'll be able to use 80% of it.
Yeah. Okay. So takeaway message from that one: speak to your broker, and there'll be different options. They'll figure it out.
Yeah.
I've actually had people come to me when they're changing jobs. They're in sales in corporate, when they're changing jobs, and they've asked me that beforehand, saying that, look, I want to get a loan as soon as I get this job. I'll have my first 2 pay slips or whatever. And because they've done that, and I've told them, you know, we need a higher, like if you want your income to be as high as possible, to borrow as much as possible, negotiate to have a higher base pay, less commissions. Because we're not going to be able to use the commissions anyway. It's a new role. You're just starting. There's no evidence. And so because they've sort of reached out beforehand and they've arranged that beforehand, and that's in their contract, we can sort of get them a higher pre-approval. But that's just because they brought it up with us earlier. So it's always a good idea to speak to the broker beforehand if you're changing jobs or before even signing a contract.
Yeah, it's good advice.
Well, ideally, just to keep it in mind, ideally, if you were to change roles and you're going for a loan after, you're not getting that commission used at all unless you're there for a minimum of 6 months to a year sometimes. So if you're changing roles, that commission is not going to be considered off the bat.
So stick it out. Don't look at your boss for 6 months. Don't get angry. Get your pre-approval, buy a house, then change.
This is all on the impression that the customer told us this is going to happen. So Ideally, I wouldn't be putting it through unless there's something going, like the customer needs to let us know this up front. Like these are sort of scenarios that we find ourselves in brokers, like a lot of brokers around the country where sometimes, like, and you see it in a lot of the posts, like we have our own brokers post on there where a customer comes back with a signed contract to sell. And when we ask them for two updated pay slip, it's a different employer. They're on a different structure. And then we're sitting there and we're like, well, what do you want us to do now? Like, we can't do nothing with this.
Yeah, keep your brokers in the loop.
Yeah.
We'll move on to, I think this is a a big one. Self-employed. You run your own business, you run a company, you work, you're a sole trader, whatever it is, self-employed. Obviously, what we've gathered beforehand is the riskier the loan or the riskier the income, the harder it is, or the more, boxes we got to tick. Obviously, PAYG, you have an income coming in, week out, pretty secure, pretty easy. Even if there's a bit of commission, whatnot, it's still pretty straightforward. Once we're getting into the self-employed space, I imagine it's very different.
Yeah. So with the self-employed, there's so many, like if a customer were to approach me, the first thing I ask was self-employed, like how long have you been running for? So in best case scenario, we need a minimum of 2 years, full tax returns, and GC registered for 2 years. Because ideally in this sort of climax, like if you're not GC registered, like you're below $75,000, that's according to the bank straight away, just part of the GC ruling. And it's pretty hard to afford that $1.8 million, $2 million home with an income less than 75K. So obviously it has to be GC registered. If we have full financials done, which basically mean the customer's up to date with their financials, it's pretty much treated as a PAYG. So we've got the full financials that are coming through. And what the full financials involved is company financials. So that includes your profit and loss, your cash flow statements, your balance sheet, liabilities, which will all be listed in the company financials. Then we further ask for ITRs, which is the individual tax returns, which basically shows how much you're paid as an individual to yourself from the company, which also is listed on the company financials. And of course, the third document that we ask is more of a confirmation, which is a notice of assessment, the NOA, which pretty much says that this has been lodged to the government, to the ATO, and this is how much they actually, said they earned this year. And we need 2 years financials. Now, in most scenarios, banks will go off the average of the 2 years. But then, of course, including myself and including most of us on here, we've just started our businesses. We've got our 1 year financials, but we just started. It wasn't as great. But our second year is awesome. As long as we've got those 2 financial years and we can paint a story for our lenders to say, listen, they've started in their first year, which is pretty much exactly what I did. We started getting better in the second year. We want to use the most recent financials of the second year because we're only going to keep growing. And that's the picture that we need to paint for these lenders. And the lenders out there, they'll listen to this, like most of the lenders would. Then it gets complicated when it has been running for that long. So let's say it's been running for less than 18 years. We do again have lenders that'll go off 1 year financials, but there's a policy rule in there in regards to we need at least 18 months, which is under a year, still under 2 years, 18 months GC registered, and we can show 1 year financials. And it will go off as 1 year financials. And again, we need to paint a picture of the reason why we're asking for this sort of lending. Again, like Mark previously said, if it's up there in the 95% LMI or the 90% LMI, it is going to be a little bit more harder to try and get as much as we can in regards to lending because there's just more of a higher risk as well in regards to self-employed. It really does get fun with our customers that come through and we're actually blessed in the sense where we're able to offer those sort of products for a lot of our lenders where customers haven't been operating that long, financials haven't been done, which is you'll find a lot is pretty normal. A lot of they are self-employed. Even though in the last 2 years, the ATO has really been chasing everyone for their BAS portals, their quarterlies, tax returns. But you still find people that haven't done their tax returns. And that's when we get pushed to more of a low doc sort of deal. The big four back in the days used to do a lot of low doc loans, but that's actually dropped off in the last couple of years. They'll maybe return later on. We don't know. But we do find out we've got a few lenders out there that go off. We need 6 business bank statements to show income going into the business bank statements. We need at least 12 months or 6 months of BAS portals to show the income coming in through your ATO, lodging those BAS portals, showing the receipt for those BAS portals as well. And then you'll find scenarios where we ask for an accountant's letter to confirm that they are earning this amount of money. Now, depending on which sort of the year that we're in as well, we might be asking for interim statements. If the lender says, listen, we're willing to still accept those sort of financials, but we need some sort of interim statements to show how well you're going this year for the next financial year, we'll be asking for evidence for that as well. Now, this differs a lot in regards to lenders, in regards to LVRs, which we all know is the loan to value ratio of how much we can borrow up to. And some lenders cap it at 80%, some lenders cap it at 85%, and you'll find very minimal lenders will cap it at 90% for low doc deals as well. But yeah, I think that pretty much covers most of it. I'll leave some questions for you to ask off your little scenarios.
You've ticked everything. It's I think the summary there is there are always options. I mean, we can throw out heaps of scenarios, and when it gets to self-employed, there are so many, different little. This one's a little bit different to that. This guy's not paying himself. This guy's doing a bit of a dodgy, whatever. There's always a lot of there's heaps of scenarios, but I think the summary there is there are a lot of options. Different banks, different lenders will offer different things for different types of self-employed. How depending on how long you've been running for, depending on how much what your LVR is going to be. Essentially, there is an option. You got your low docs as well. There's always some sort of way to not work around it, but there's always an option, and it might not work at the end. If it's only been running for 6 months or so, it seems like that's just not going to happen. Or if
there is, but then you're going to be running at a very high fees, high interest rates. It's always a catch.
So there's options. And so if you are self-employed, it's probably just easier to speak to you guys and just figure it out. What's the best option? Mark, do you have anything to add to self-employed or?
Yeah, I was going to ask a question. So very common with the self-employed that I see, and I'm sure that you see as well. People don't want to run profitably because they're going to end up paying tax on that. And so the accountant will be creative in what they sort of expense in the company. When someone is running at a loss, but like on paper it's a loss in their tax returns and stuff, but they're actually profitable. How does that?
So we see a lot of scenarios coming through in regards to self-employed where people are not paying them, like Mark said, to save on tax. And I think that's why that low doc option is there, because lenders know that most self-employed people try to save much on tax because self-employed people are taxed at 30%. There's a few lenders out there that go off company profits as well. So we get to add backs. There's a lot of add backs in self-employed, depreciation add back, interest add back. And we take into account the company profits as well. It depends on what lenders that we go through. In regards to a company running at a loss, that's going to automatically raise a red flag, because especially if the company's been around for 5 years, the banks are going to say, wait a minute, this company's been around for a 5-year term and it's still running at a loss. This raises red flags. If it's running at a loss, keep in mind that's going to be taken out of your individual income that we're reporting to the bank, or it's going to be taken out of the profits that we're reporting to the bank out of your business. So I guess most self-employed people are always running at a profit and they pay themselves a little minimum wage, and we try to go off those company profits. But that's why those low doc options are out there, because there are lenders out there, most lenders already know this as well, that self-employed people try to, of course, save as much as they can on tax. And like with accountants, they try their best to save their customers on tax as well. And that's where it comes through. A lot of the government rebates come back as well on the writing off assets if you're self-employed to take off your income. So if you're earning 60K a year and you buy a car for a car loan for 20K, you get to write off that off your income for about 20K. You end up making 40K. So that's why we're dying for an accountant to come on, because he tells us this sort of information in regards to like how it all works. But that's how lenders are looking at it. Ideally, I'm just going to be pretty much straight. Like I've been telling you guys, I've been pretty straight with my customers lately. When you're coming to a self-employed, if your financials are done and you've paid yourself a wage and there's profits in the business, that's the best case scenario, because you're really treated as a PAYG. And it's PAYG interest rates, PAYG products and features and all of that. If we're going towards the low doc, there's a lot more ruling around there. There might be a little bit more fees if you're going to the LMI territory, management risk fees, because the banks are really looking to cover themselves if anything were to go wrong.
Very informative. I've got a lot of questions, but
self-employed is a huge world. Like I can go forever about self-employed. Yeah,
for sure. But I think again, it's just a matter of, it seems when you're self-employed, tax deductions are great, but it doesn't help when you come for lending, because you want to show that you're making more and more money. So
Yeah.
the more money you're making, I guess, just the overall better in any, whether you're self-employed or not.
Yeah.
So the only thing I have to say from a employment and lending and the property purchasing perspective is, and we say this kind of every week, is when you have your pre-approval ready, and it's why it's so important, especially if you've got different types of employment, if it's commission or self-employed, to have that pre-approval ready to go before you start looking at property. When you've got that pre-approval and you're confident with the numbers that you can work on, and we're not changing jobs halfway through a property search, it makes it a lot easier to negotiate and get a deal when it comes to the actual purchasing part of it. You know, it's, if two people are presenting an offer and they're both the same figure, or even one's, you know, they're both the same, you know, price, both $500,000 on a property. If one is already pre-approved, finances is good, you know, it's more likely to go ahead than the other one who hasn't got a pre-approval yet, still has to do an entire process with the lender. The vendor, the seller, is more likely than not to pick the person that's just ready to go. And it gives you as a buyer, when you're negotiating, just that edge as well when it comes to speed of action. You know, especially in hot markets and areas that we buy in where it's very, very hot and very tight and there's no supply and a lot of demand, properties are selling within 2-3 days, sometimes within the same day. And if you're not ready and you don't have a pre-approval, you can't actually negotiate, or you can't bid confidently on those purchases. So that's the only thing I've got to say. I feel like I say it every week: have a pre-approval before you try and purchase a property.
And how important was that last year, especially when, like, we go through like phases with real estate agents in general. So going last year, where if you weren't ready to buy there and then, you're missing out on that property. And I think you know that best of all, like how many auctions you go to, or how many bids, or, you know, you putting bids for most, like a lot of our customers. If they weren't ready to pay right there and there, and they wanted 2 minutes to think about it, you call back in 2 minutes, your agent, that house is gone.
Yeah.
How important is that?
The last 12 months or 18 months to 24 months, you know, the market has just been ridiculously, like, absolutely crazy. And 100% right. Unconditional offers was the norm. We never bought anything.
66W.
Yeah, 66W.
We can't forget the 66W. Yeah.
That's it. Or interstate, you just have no finance, no building, like just nothing. We never purchased anything really like that. We always protect the client, but it was definitely harder. Even if we were pre-approved, just having a finance clause in there, or wanting to do building and pest, someone else is ready to drop money unconditional.
And what is that? Explain that to our listeners. What is that 66W? So when you go to an auction, or not even an auctions no more, real estate's practicing this, like, it's become a bit of a norm in regards to when you're going to purchase a property, even if you're looking to bid without auction. What is that 66W? What does that mean? Yeah.
So when you buy a property, you generally, every state is different in terms of the time frame. You generally have a cooling off period, and in that cooling off period, it literally means, you know, you've bought this property, you've got 5 days, 2 days, 10 days, whatever it is, depending on your state, to cool off, to calm down. You know, it was a bit feisty during the negotiation. You got to be excited. You bid 50 grand more than you actually have, whatever it is, and it gives you that time to cool off, and you can actually withdraw from the purchase. And you'll lose your initial deposit, which is in Sydney at 0.25%. So it's a couple grand usually. You lose the $2,000, but you can back off, and that's all you really lose. And you say, sorry, I don't actually have these kind of funds, whatnot. A 66W was originally used at auctions, because when you purchase a property at auction, you don't have a cooling off period. You purchase the property at auction, you're paying a 5 to 10% deposit there and then.
Right there.
There's no cooling off. You better be ready when you're buying, and that's why it's so important to have your pre-approval, especially with auctions. Okay. What was happening, and what still happens during a hot market, is agents will say to you, hey, sign a 60, even if it's not an auction, private negotiation. We're looking at a property, we've got a deal, but they'll say, hey, to really win this deal, you got to sign a 66W, which is a form which is waiving your right to a cooling off period, which means you're saying, hey, I'm going to buy this no matter what. If I pull out, I'm going to lose my 5 or 10%, which obviously in Sydney, if we're talking about $1 million property, we're talking big money now. We're not talking a couple grand. We're talking 50, 100, $200,000 sometimes, depending on the purchase price. So essentially, that signing of a 66W is confirmation to the seller. This property is definitely going ahead. If the buyer pulled out, well, you just pocketed 100 grand on top, and you're going to resell. So 66W is a way to say there is no conditions for me to buy this property. I'm going to buy it no matter what. I don't need to check with my bank. Because I've already done that. I don't need to do a building and pest inspection. Probably have done that prior to getting a deal. Everything is already done. We get a deal, it's done. There's nothing that's going to change. So to even think about signing a 66W or going unconditional, you cannot be doing it without having a pre-approval. It's just crazy, absolutely crazy. Because if you do, and when you go to Fadi, you go to Mark, you go to anyone, they say, I don't know what you're talking about, you definitely can't get a loan. You have lost that deposit. It's absolutely insane. So definitely like the most important thing in the world, get a pre-approval if you're going to buy property.
Yeah, and it's important as well, Mark, it's important as well in regards to the auction. If you have a pre-approval in place and you're speaking to KM or you're speaking to Mark and you're like, listen, I'm going this weekend to this auction and I want a bid, speak to your broker. We can actually, like, all you have to do is supply us with the bidding number, your spot on that weekend. We send that blank contract to sell to the lenders and try and get you more of a, not a formal, but more of a conditional approval that this security is suitable for your lending and you're able to afford it. So when you do go on the weekend, you're bidding with a lot more confidence as well. And I'd say getting in contact with your broker as soon as possible. Don't call us the day before and say, I'm going to an auction tomorrow. I need this approved. We need that, what is that, Mark? Minimum what? 48 to 72 hours if we're lucky. But we'd like to ask for 10 days or 5 days. Give us 5 days. That's something to work with. But what's the shortest period that we've tried to get it done in? And we have done it like 2-3 days, I think.
I've had it done in 2-3 days, but if there's conditions, then we have to wait for you to send us stuff because you're at work 9 to 5, and then we send it to them. Like, it's not happening in 2 to 3 days. So typically, a week or two, like you said. If you know you're going to an auction, why risk it? Like, it doesn't cost you anything to send us the contract of sale. It doesn't cost us anything to send it through to the lender. It just gives you confirmation. So there's no reason not to do it. The other thing I was going to say is, Kiro, you purchase a lot of properties off market. I've had a customer last week purchase off market, signing a 66W off market. Is that typical with your off market deals?
No. With our off markets, especially off markets, I definitely like to have a finance clause in there. If we're buying interstate, we typically have finance clauses. If it's in Sydney, I would ask for just a standards cooling off for the brokers or for you guys to be able to get that unconditional without having to risk. Especially when property is off market, it could be off market for a few reasons. It could be no reason and it's just a quick sale and a good relationship with an agent or something. But it could be that the property is being renovated as they speak. It could be distressed sale, deceased estate. There's a lot of reasons. But usually if there's an off market, and it could be the vendor is secretive and doesn't want people to know they're selling. And a lot of those properties, there's going to be no information online from the back end in terms of where the valuers check. And my biggest worry with an off market would be the valuation coming undervalue, especially if the valuers is going to look on Logic or online or whatever, do a desktop, and the property is being completely renovated. So with off market stuff, 66Ws. Again, obviously 66W, so it's in Sydney. It's a pressure tactic from the agent to say, hey, if you really want this off market, sign a 66W. Otherwise, we're going to take it to market. We don't really like that. If it's an off market, we're trying to get a good deal for everyone. The vendor's not paying for marketing, is getting a quick turnaround time. We want in return, give us a week or two so that the brokers can do what they need to do. So typically we don't go unconditional off market. Typically we don't go unconditional ever, unless it's an auction, to be honest. Unless we've done our every due diligence and the property's like $100,000 undervalued and it's so clearly obvious like that there's a huge undervalue, then I'd be more inclined to go unconditional if we had to. But even then, I'd still like to have a finance clause or the opportunity for the brokers to do what they need to do to get it unconditional.
And that can of worms about purchasing off plan. And like, I know most of us are not fans of it. And that's something that Man, when I got into this industry, I didn't really know much about off plans or how the contracts are looked at. And after, being in the industry for a while and customers are coming through, and we've dealt with customers that purchased something that wasn't ready till 3.5, 4 years later. I know this is a whole nother topic, so I'm not going to open it too much. But man, I've always thought to myself in those sort of scenarios, and we've dealt with customers that have gone through that. There has to be some more to that contract that's written by the builders, builders solicitors, where if it's come to a certain point, or it's never going to happen because the builders are not going to want to do this. But if it comes to a certain point and the banks are undervaluing the property, and it's very hard to get those people that signed on a contract 3 years ago, there has to be something in that contract that protects customers more. Like, I don't see it happening, but there should be.
Yeah.
That's a can of worms that it annoys me because we've dealt with customers before and it's out of their hand.
Yeah.
It's completely out of their hand. It's completely out of our hand. It's completely out of your hand. But that contract, to me, by the builders or the developers, whatever it may be, it's really only benefiting them. And that's what makes me worry when I speak to customers. We talk about responsible lending. We sit down and we're like, this is in 3 years. That means in 3 years, the only change that you should be having is your income just increasing nonstop, saving as much as you can, because we need to make sure that in 3 years, we're in this exact same scenario to afford the loan. And in 3 years, lending can change, borrowing capacity can change. And I think the last 2 years taught us anything can happen. So with happening it too much, like that's what it boils my blood in regards to the contracts that are written.
Yeah.
Well, yeah.
Yeah. So me and you actually did a episode on the First Brick podcast a long time ago about off the plan. Just to clarify, you were talking about off the plan properties there, which are properties that haven't been built. Whereas Mark, I believe, was talking about an off market, whereas the property there,
off
it's
the
just
market,
it's not on real estate or whatever. Just so if anyone got confused there. But yeah, off the plan is definitely a topic for another day because I think we've been going for about 45 minutes. So Mark's gonna have to do some good editing today.
We'll be in
Cut this up like 4
segments.
parts. Anything else to add, or happy with that?
No, I think that was pretty thorough. Like, obviously, we can go into a lot more, but we can keep it for another day.
Yeah, cool. I liked it. It was a good episode.
I think what's the key points? Make sure you have a pre-approval. Yeah. Speak to your broker. Make sure you got a pre-approval before you go see First Brick.
But I think the major point is
don't change jobs. If you are going to change jobs, let us know in advance. Like, because we've been put in a position before, and I'm like, please tell me it's a full-time job you've just gotten. Please tell me there's no that much probation. Please make sure we're not using commission. We don't like. We have to be in the know. Yeah, and that's a discussion that we have with all our customers. Yeah.
Yeah, I think definitely big point is, regardless of your industry, your job, how you get paid, speak to your broker because there's probably some sort of option out there for you. And then if you are already in the process of getting a pre-approval, if there are going to be any changes, definitely speak to your brokers before you make those changes, at least so you are informed of the impact that it will have on your current borrowing situation.
Yeah. So pre-approval is not a final approval. And I think that's what everyone everyone needs to know. Yeah.
Cool. All right. Thanks, boys. We'll sign off.
Awesome.
Take care. See you next week.
Thanks, guys. See you later.
Bye.
Mark just